All right, we're doing a mic test just to make sure the mic and video as well are working this morning. Conducting another mic test and video test to ensure that it's working. Video and mic check number 2. Testing the mic and video. Testing the microphone to make sure that we've got good audio and video. Testing the microphone to make sure that we've got good audio, testing video to make sure that we've got good video. For those of you in the room currently, we will be starting here in the next few minutes at 10 a.m. and look forward to having you here today. So we'll be back with you to check in just a moment. All right, we're now live. Thank you guys for joining us today. My name is Josh Crowe, and I'm the owner and founder of Sunpath Financial, a retirement and wealth management tax planning firm here in Newport Beach, California. And today I'm going to be your host for the Social Security and tax planning webinar. So for those of you just getting in, welcome. I'm glad to have you guys. I'm just making sure that you can all get in and hopefully you can hear me. You may have noticed here on YouTube, we got a couple streams going, Facebook, YouTube, and a variety of others, that there's a chat box on YouTube to the right, and we prefer using that. So if you guys got questions along the way, you're more than welcome to plug them in there. At the end of today's event, I'll go ahead and jump to a Q&A, and I'll answer any of those questions that you guys have posted, or if you guys have any questions at the end that you've come up with, go ahead and plug them in there. I would say if you've got questions that come to mind, at least jot them down or plug them in there, because oftentimes you'll end up forgetting those questions by the end of the event. Before we get into the topic of discussion, I want to go ahead and give you guys a little background on ourselves. Who is Sunpath Financial? What do we do? Well, first of all, Sunpath Financial was started in 2016. So we've been in business for ourselves for about 8 years, going on 8 years now. But as far as for myself and some of the others at the firm, we've been in the business for a long time. So for me, I started at my grandfather's tax business, CPA firm, 20 years ago, did about 10 years of taxes. and then joined one of the largest financial firms, retirement firms in the world, Prudential, in Irvine, California. And after several years of being mentored there, I went off and started Sunpath Financial today. And the reason I did that was because Prudential was well known for being kind of a full service firm. They did a lot of different things, and we wanted to focus on retirement. So that's what we're doing today. We have been recognized for talking on the topic of retirement by several different PR firms such as Forbes. In addition on the work that we do in retirement, we also host a series of these educational webinars. You guys can see those. Hopefully you can see those now on the screen. And so we not only talk on Social Security, but Medicare is another big topic. You've got retirement taxes. We're going to talk a little on taxes today, but that's a little more in depth on retirement taxes, retirement income. So you've got pensions, Social Security income, we know that, but making sure that you get the best decision when it comes to completing your Social Security and pension packets or applications, but then also working with 401ks and IRAs, because those will be used to supplement that income. Estate planning, we do have an estate planner that we work with, and we'll bring them into the events so they can talk to you guys on the importance of setting up a trust and then retirement planning as a whole. Now, moving on to our next slide here, you can see and you know today that we are retirement educators. We're income planners as well. So again, making sure that you've guys got the income ducks in a row, but then also that if you've got expenses that are greater than that income, that you know how to appropriate your retirement savings in order to use that as a third source or as a supplement to your pension and Social Security. We'll talk a little bit more about that later. Tax strategists, wealth managers and investment advisors, 401k, IRA, retirement accounts, savings accounts. Those are the types of things that we work with here. And then we do have an insurance kind of arm to the company as well, where we're helping folks with life insurance and long-term care, because those kind of fall to the components of a retirement plan. We are not alone. We do have several partners that we work with. The first being Charles Schwab, and we have that relationship so that we don't take custody of client funds. We manage everything at an arm's length. That makes the clients feel good. We do have trading authority, so we can make all the trades for you according to your plan. Next would be Advisors Excel, and they're the ones that help us on the insurance side, life insurance, long-term care. And they've been in business for a very long time. They're in Kansas. They're the largest kind of liaison between firms like ourselves and large insurance companies. We are an RIA, which means that we're a registered investment advisory firm with SEC in the state of California. This does put us in a position of fiduciary role, meaning that we've got to do in what's best for the client's interest above our own. Again, kind of noting on that Forbes, we've been written up in Forbes a couple of times, mostly on our talks about retirement. And I personally, and a partner of ours here at the firm, Albert Lee, are an author on a book of retirement. And so, again, we've spent quite a bit of time studying and educating folks on the topic. And hopefully you guys take a good education and some value out of today. And so, obviously, you came in here to learn about Social Security. And this is the Social Security Planning and Maximization webinar. I'll also be talking on taxes, how your Social Security benefit will be taxed. And then I'll give you guys a few tips as to how you can reduce your lifetime tax liability throughout retirement. So without further ado, let's go ahead and get started on today's topic of Social Security. So many of you probably know that Social Security is a critical component of your retirement. And to kind of paint the picture for you, 40% of those who are currently in retirement, 100% of their income is derived from Social Security alone. The other 60%, 40% of their income is from the Social Security, from their Social Security benefit. And if that doesn't drive the point home for you, let's take a look at kind of an average monthly benefit. This could be for a single or a couple. Just depends on how many working credits you guys may have had, and your income, and a few other components. But if we just say about the average is $2,000 a month, over a 10-year span, that's about $256,000. And I'm going to pause there for a second, because if anybody knows the average retiree savings at retirement, if anybody could guess in the chat, that would be great. Yeah, you guys can type there in the chat box. We'll kind of do and try to make it a little engaging. So anybody have an idea as to how much the average retiree has saved by the time they get to retirement, say the age 65? And it doesn't look like we're getting any responses, but I will give you the answer, and that's about $130,000. So over the first 10 years, actually less, about the first 6 or 7 years or so, you will have received in benefit as much as it takes the average retiree to accumulate a lifetime of retirement savings. On a 15 years out, you're looking at 400,000. On a 20 years out, it's about $500,000. And then moving on to 25 years, it's about $750,000 that you will have received in Social Security benefits. So trust me when I say your Social Security benefit is a big component of retirement. You're going to want to make sure you get an education before you file because there are a lot of moving parts. And once you make the decision to start your benefit, there is no going back. You actually technically have 12 months. Within the first 12 months, if you decide that you didn't make the right choice, that you may want to delay a little longer, you can pay back the benefits that you received and it'll restart the clock. But after that 12 months is up, that is it. You will receive that benefit for the rest of your life. There is no going back. Now, moving on to the topics of today. So I'm going to give you guys a fundamental understanding of your Social Security benefit with the basics. We're going to talk about spousal benefits, how a divorcee can file for a benefit based on a previous relationship, even for survivors. Or if you have a spouse, you can claim a spousal benefit where you're taking some portion of their benefit, not to reduce theirs, but in addition to theirs. We'll get there in just a moment. Determining your benefit, how you can factor or figure how much, an estimate you're going to receive at the age you decide to retire. And even if you decide to retire at a time that's not listed on the Social Security Administration's website, ssa.gov, and if your income changes. We'll get there in just a moment. We'll get off to taxation, how your benefit is taxed, and then also I will give you guys several tips on how to reduce your lifetime tax liability. And then I'll kind of wrap it all up with a small offer there at the end. It's kind of a financial planning consultation offer. We'll get to a Q&A and we'll let you guys out of here. So let's go ahead and get started on the basics. So Social Security, most of us know how it works at a very high level. So you're earning wages from your employer, and if you're working for what's called a covered employer, which is one where you're paying FICA tax. FICA tax is split into two taxes. First, you have Social Security, and secondly, you have Medicare. Now, Social Security tax is 6.2% of your earned wages. There is a ceiling. It's about $140,000 or so. Once you hit the ceiling, everything you earn over that amount is no longer subject to that 6.2%. But the majority of Americans and working Americans are going to be under that ceiling and have to pay about 6.2% of their total annual wages to the Social Security Administration. Now that goes into a bucket, and that will actually be used to pay people who are currently in retirement and receiving a benefit. So your money goes straight into the bucket and out the other side to pay a retiree his or her benefits. Now, when you get to retirement, it's the same deal. You will then retire and be receiving benefits from others who are paying in to that bucket. One thing to keep in mind when it comes to your benefit and filing, and I kind of put this at the front of the presentation because it is important. If you decide to file at 62, which is fine, that's the earliest you can file. If you do decide to file at the age of 62, you'll want to make sure that you're filing 3 months prior to your desired start date. Okay, so that means that, sorry, I'm just checking our link here. That means that 3 months before, it takes a little while for the administration to catch up, right? They've got a lot of processing they have to do on a monthly basis. So giving them 3 months in advance will ensure that you'll receive your benefit within about a month after you have elected to start your benefit. Okay, so however, you cannot file early if you decide to take your benefits at 62. So that 3 months is kind of out the window. Now, if you do file at 62, you're going to have to wait a few months in order to collect your benefit. This is where some clients have made mistakes. They've gone ahead and thought to themselves, I'm going to retire at 62, and on that day I will file my application, thinking they're going to receive that first check within the first couple weeks. It doesn't happen that way. It can take a few months before they receive that first benefit. Unfortunately, they can't go back to work because, well, they've disengaged from work, they've resigned. So just make sure that if you decide to go out at 62, it's the only age where you cannot file 3 months in advance. Any other age, say you want to retire at 65 or 66, your full retirement age, if born between 43 and 54, you can go ahead and file 3 months in advance, and you can expect to receive that first check right around your commencement date, the date of retirement. So just an important consideration for all of you guys. Now let's get into how Social Security is kind of the components that it's made up of. And there are two components that are really important. The first is your primary insurance amount. Now, your primary insurance amount is the amount, it's 100% of your benefit that you are to receive at what's called your normal retirement age. And your normal retirement age depends upon the year in which you were born. And so I've got a little chart here for you guys. And we can see for those at the very top here, born between 1943 and 1954, their normal retirement age is 66. And that means that you're going to receive 100% of the benefit you're entitled to when they calculate it at your age 66. Now, for those born in 1955, it's 66 and 2 months. And then it increments by 2 months all the way up until those born 1960 and later, and your normal retirement age is 67. So you could do yourself a favor here and just quickly find where you fall. And then to the right, that will dictate when you'll be entitled to 100% of your benefit. Now, your primary insurance amount can change. It's 100% at your full retirement age as seen on the previous slide. But it can change if you decide to start your benefit early or later. Okay, it will decrease if you decide to take it early, and it will increase if you decide to take it later. Let's give you guys an example. So the individual I'm going to use for the presentation is going to be somebody who is born between 1943 and 54 with a full retirement age of 66. Now, we've gone ahead and stated that they have a $2,000 monthly as used earlier in the example. So let's assume at 66, their primary insurance amount is 100%. When they decide to collect, they will receive that $2,000. $2,000, their primary insurance amount. Now, if they decide to take early, they will have a 25% reduction in their benefits. So here we have age 62 early, the earliest. So they're going to receive 75% of their benefit, or $1,500. So that $2,000 has been reduced by $500 to $1,500 per month. Now, moving on to their full retirement age, we know that, as stated, it's 100% of that benefit. So they'll receive $2,000 if they wait until they reach their full retirement age. For you, you saw the previous slide. If you found your age there, maybe 1955, say, 66 and 2 months. As soon as you hit the 2-month mark, you're now entitled to 100%, your full PIA, primary insurance amount. If you delay until age 70, they will actually give you an 8% increase for every year that you delay. So that is up to 132%. It is simple interest, not compounding. So it's just a clean 8% every year based on your primary insurance amount. So it's 8% of $2,000 for that first year. It's like 160, and then so on and so forth for the remaining 4 years this person would delay. So their benefit would end up being $2,640 for having waited those few years. Now, moving on to the next slide here, we'll give you guys an example of what some other ages might look like. So let's get beyond age 66, the full retirement age of 66. Let's see how this would look for somebody born in 1955. So again, they have a normal retirement age of 66 and 2 months. They've got this 8% increase here. We know that. But if they decide to take early, because they're born a little later, their early Their early percentage is 74.5%. They'll get 74.5% of their full retirement benefit. At their normal retirement age of 66 and 2 months, they're entitled to 100%. And if they delay, they're going to receive 130.5%, about 1.5% down from the person who's born earlier. Now, moving right along here to our final example at the bottom. If you guys want, you can take a screenshot here or a photo, but I'm going to move down to 1960 and later. And we can see the normal retirement age was 67. Now, their early at age 62 would be 70%. 70% of their primary insurance amount, 100% at 67, and then 124% for waiting those extra few years. Okay, so moving right along to our next slide. We've realized that there is a significant difference in filing early versus later. As a matter of fact, that difference was, $1,500 less 2640 less 1,500. And so that's about $1,140 difference to be received every month for the rest of your life. So a pretty strong difference, in making the decision about when to start your benefit is critical. Now, a question that comes up often, it's the most common question we've gotten as retirement planners, especially around the topic of Social Security, is when to begin my benefits. When should I start them? What makes sense for me and my family, my spouse? And it really depends. One of the things it will depend on is if you have other income resources. If you've got rental properties that are generating passive income, you can use to offset or pay those monthly expenses while you let your benefit, grow. That's a big consideration. Another one is if you're married, there are spousal benefits and strategies that you can implement in order to kind of live off of one Social Security benefit while the other is delayed. Another consideration is if you will continue to work. Now, I mentioned earlier on the topics of today that there's something called a work penalty, and we'll get there in greater length. However, if you decide to continue working without collecting your benefit, there's no penalty to face. And you can continue using those earned wages to pay your expenses like you always have, right? And I think that's pretty obvious, but worth stating. Another one is if you expect to live a long life, because the longer you plan on living, the more money you're going to need in the future, especially with inflation being as high as it has been over the last couple of years. We've all noticed it's taken a big hit on the pocket this last few years. If you expect to live a long life, the price of goods and services in the future are going to cost a lot more. You're going to need to make up for that. And so that is a big consideration. And another question is, if you do plan to live a long life, is how long will it take for you to recoup those benefits? See, a problem for a lot of people in delaying is they're thinking, well, if I delay to 66, I'm now giving up 4 years. Even if it was only $1,500, that's 75%. I'm giving up 4 years of that. So that's about $72,000 over a 4-year period. And so it's hard for them to think, oh, well, I'm going to continue to delay and delay for that bigger benefit. So one of the ways we help people resolve this is with something called the break-even analysis. How long will it take to recoup those benefits? And there are kind of a couple different versions. There is a simple and complex version for today's kind of a sake of time, keeping things simple and short. We're going to go with that simple method. So let me give it to you guys just straight. If you plan on, like in this first row, to delay your benefit to 66, not starting early, starting at your full retirement age, whatever that is, your break even is going to be about 11 years. In other words, to clarify this a bit, if this person started early, we learned in the example, if they start early, they're going to be collecting $1,500 a month. $1,500 a month multiplied by 12, so over 12 months, that's $18,000 per year. Now that's over 4 years, from 62 to 66. So 18,000 times 4 is $72,000. They have forfeited receiving $72,000 over those 4 years for an extra $500 a month at the age 66, because they will receive $2,000 a month. So that additional $5,000 a month, or $500 a month, excuse me, is $6,000 over the course of a year. So it's simply the $72,000 that they did not collect divided by that $6,000 per year. $1,500, the difference is $1,500 and $2,000. And that is 11 years. In other words, when you hit the 11-year mark, if you decided to delay your benefit, by the time you hit your 11-year mark, every month after that, you made the right choice. If you die prematurely before the age 77, you still made a good choice, but you may have not made the right choice in terms of maximizing your benefit. Now that number happens to be 81 with COLA, and we'll get to COLA in just a moment so you guys know what that means. Now, what if you delay to age 70? How long then will it take for you to break even? And that's approximately 10 years, 84 with COLA. And then lastly, if you plan to continue working, so you'll pay Social Security tax up and through age 66 and then delay to 70, the break even is 81 and 86 with COLA. So moving on, what is the a cost of living adjustment? What is COLA, I should say, because that's what I referenced it in the last slide. COLA stands for Cost of Living Adjustment, and it is a raise from the Social Security Administration on an annual basis to your benefit in order to offset the rising cost of goods and services. Now, the percentage that they're going to raise or increase your benefit by is based on something called CPIW. And I'll keep this really simple because that formula gets complex. But CPIW stands for Consumer Price Index. And the easiest way to think about this is if you were to walk into a grocery store and fill up a grocery cart full of goods and check the price of those goods 1 year later, there's going to be a difference there. Do you think the price of those goods is going to be higher or lower in the future? Well, the price of those goods is going to be higher likely in the future. And that's just how things have gradually moved over time. Even though some years inflation is lower or higher than others, over time the price of things have gone up. They've never really gone down. So that CPIW is the Social Security's way of dictating how much of a raise they're going to apply to your benefit. They're simply taking a look at how much goods and services have increased over the course of a year, and then they're applying that to your benefit. A few things to know about COLA. So first of all, it's based on third quarter to third quarter. But one thing that you might want to consider is that it's not announced until October, which most of the retirees get pretty excited come October. When they see those pumpkins outside, they're thinking, okay, here comes my increase. And the last couple of years have been significant. But you can see it there, 2023 down here in the bottom right, it was 8.7%. But keep in mind that even though it's announced in October, it's not effective until January the following year. So don't go spending the money in September because that check will not have increased yet. You'll have to wait until January 1st of the following year for that benefit to receive its increase. Now let's take a look at COLA over, say 40, 45 years, since 1975. Now in that first column here on the very far left, we see that inflation and COLA were very high. This is back in the Carter days. And then when Reagan came in with trickle-down economics, we can see that things changed dramatically. COLA increases were really low. Inflation was really low all the way up until kind of 2008 where we had you guys probably remember the financial crisis. And then we went back to a low kind of inflation environment and COLA adjustments were pretty low as well. And only up until recently, these last 2 years, have we seen some pretty big digits. In 2022, it was 5.9%. And this year in 2023, it was 8.7%. So pretty significant increases. The average over about 40, 45 years has been 3.66%. And most recent 10 or 11 years or so has been about 2.16. Now moving on to spousal benefits. So again, you can receive a benefit, and this is rather cool. I love this part about the Social Security benefit because we got a lot of homemakers out there. You can receive a benefit based upon your earning record or your spouse's earning record, which is pretty amazing. Now, what does it take to be eligible? Say you didn't work. You did work because a lot of us were home and caregiving to the children, which in my opinion is just as hard, if not harder, than going off to the daily. But you must have been married 1 full year immediately before the application. So you can't just get married and go file. You got to wait at least 1 year. You must be at least age 62. We learned that earlier. And the worker spouse, the person who you're filing off of, must have filed their application for benefits already. They must be collecting their benefits before you can take a benefit based off of their benefit. Another consideration is that your benefit, the benefit based on your own earning record must be lower than the benefit based on your spouse. And I think that's pretty obvious. Nobody would take their benefit if it was lower than the one they could get from their spouse. But that's also another consideration, is that if you're entitled to a benefit, so some of us didn't work, maybe there are a few out there who worked part-time for 5 years or so, didn't necessarily get 40 credits, or just didn't have an income that really produced a very high, didn't pay a whole lot in the Social Security bucket, so their benefit wasn't, it wasn't higher than what it would be if they filed off their spouse. That's the greatest part. You too are entitled to a benefit, the higher of the two. Now, moving on to how much you can expect to receive as a spousal benefit. If you claim early at 62, so you being the spouse who is filing off of your working spouse's benefit, so you're the one that's filing for spousal benefit. If you do that at 62, you're going to receive 32.5% of the worker's spouse's benefit. Now, if you wait to your full retirement age, you will receive 50% of their benefit, which is pretty strong. To give you an example, if we've got a $2,000 monthly benefit as used in the example today, and that's the worker benefit, your spouse who has filed, at your age 62, you'll receive $650 per month. Now, if you wait till your age, your full retirement age, which again is based upon when you were born, we saw that slide earlier. And if anybody wants that slide, I can send it to you. It's not a problem. Just let me know in the chat. It is $1,000 a month. Now, another consideration here is that it will never grow beyond 50%. So we saw earlier where if you delay up until 70, they're going to give you that 8% increase to your benefit. That's not the case for the spousal benefit. 50% is the maximum you can receive when filing for spousal. Now, another consideration with spousal benefits is that if the two of you are claiming benefits, whether spousal or you've claimed benefits based on each of your own's earning record, the first to die will leave the higher of the two benefits to the surviving spouse. So, for example, if your benefit's $2,000 a month and your spouse's is $1,500 a month and you die, they are not to be stuck with the $1,500. They will be stepped up to your $2,000 monthly benefit. Obviously, that's less income for the household because combined your benefits was $3,500 a month. They are now receiving $2,000, but it is better than them only receiving their $1,500 benefit. So the surviving spouse will only ever retain the larger of those two benefits. Now, for divorced spouses, there is a benefit opportunity for you too. So eligibility is you must be at least 62 and currently unmarried. You must have been married for at least 10 years and divorced for 2. Not eligible for equal or higher benefit based upon own earning record. I was mentioning that earlier with the spousal benefit. If you've got a benefit of your own that's going to produce a higher monthly benefit, well then this wouldn't make sense for you anyway. So I think it's pretty obvious, but worth mentioning for those who didn't know. Now, another consideration is that former spouses can receive a spousal benefit based upon previous spouse's earning record. Okay, so it can be any spouse, and typically you want to go for the spouse's earning record that's going to produce the highest monthly benefit, as said. And an ex-spouse, here's the big takeaway, is that an ex-spouse does not have to claim benefits in order to file for spousal benefits. Earlier we learned with a spousal benefit for two living spouses, you have to wait for the working spouse to begin their benefit. That is not the case for divorced spouse. They don't have to have started their benefit for you to start yours based on their earning record, which I think is another pretty awesome feature of a Social Security Administration's benefit program, retirement program. Now, another consideration for you, and this may not work for everybody, but worth mentioning, is a strategy called restricted application. And this is a way to kind of increase or maximize your lifetime benefits, between you and your spouse, because it's done for spouses in the spousal section only here. But both spouses have attained, it's used when both spouses have attained their normal retirement age. So again, that was on the chart we saw earlier. For these two, it's age 66. Income is needed or desired, and the goal is to continue to grow the lesser of the two benefits to age 70. So let's take a look at an example. If we've got a spouse with a larger benefit, they're going to go ahead and claim. They're going to file an application and begin their benefits. Now, that normal benefit will provide the household with income. The second spouse is going to file but restrict their application and then apply for the spousal benefit that we learned about earlier. Now, that allows that primary benefit, their benefit, to grow while they collect the spousal benefit to provide the household with more income. Let's take a look at an example with some figures, some numbers, and I think that'll help drive it home for you guys. So we've got Mona here, who is age 66, born between 43 and 54 if we're following. She files for her benefits at the age of 66, and her monthly benefits to be $2,000 a month. So she's going to receive that $2,000 per month in perpetuity. That's it. She's done filing. Now, Rob comes along. He's also age 66, and he wants to maximize the household's income. So Rob's own benefit, he's going to get a little more if he files on his own earning record, which is $1,500 a month. But they want his benefit to grow, and they've got this opportunity to do so. How? Well, by restricting his application or his benefit of $1,500 a month and instead filing for the spousal. And we learned earlier that at your full retirement age, if you're taking a spousal benefit, it's 50% of your working spouse's benefit. And in this case, 50% of Mona's benefit is $1,000 a month. In the meantime, Rob's $1,500 benefit will grow by 8% per year until he is age 70. And now that $1,500 has become $1,980. We see that in the lower right side of the screen. So he has earned he's earning an additional $480 per month. In the meantime, he was receiving $1,000 a month, and this household is now at $3,000 a month, $1,000 over what Mona would have received on her own. One consideration is that only one spouse can file for a restricted application, and the next is that it only, like I said earlier in the slide, is going to work for so many people because it's limited to those born between May 1st, 1950 and January 1st, 1954. So most of those with a normal retirement age. So let's move on now to the work penalty. We did a video on this earlier, and we've been posting more on YouTube, and it got a lot of attention because there's a lot to the work penalty, and I'm going to make it simple for you guys today, but there is a lot to it. So first of all, what is this work penalty? The work penalty is a penalty on your Social Security benefit by the administration for you earning wages and collecting your Social Security benefit. That is it in a nutshell. Now, what does working generally mean? Well, what doesn't it mean is pension investment annuity income. Those typically don't count as income against the earnings test. Earnings test will come up in just a moment here. But that's income that you can usually collect without having to worry about a penalty. Self-employment commissions, fees, and passive income, obviously earned wages like for W-2 employees, those things are likely to count towards the earning test. So what is this earning test? Now, the earning test, let me jump ahead of this slide here. The earning test has a few components, and the first is the exempt amount. The exempt amount is the maximum that you can earn before paying a penalty. Before reaching your full retirement age, that amount is $21,240 in the year of 2023. So let me rewind a little bit. If you plan to continue working while taking your benefit, say you're 63, 64, you've decided, you know what, I want to go ahead and file. You file for your benefit. You're now collecting both your W-2 earned wages and your Social Security benefit. If your W-2 wages are less than $21,240 per year, you don't have to worry about a penalty. However, if they are more than $21,240 per year, you do have to worry about a penalty. And that penalty is $1 in benefits withheld for every $2 over this exempt amount. It's a 50% penalty to your benefit. In the year that you reach your normal retirement age, so let's say you turn, in this example, 66 in July of 2023, so this year, that exempt amount for them will have moved up to $56,520. So in the year you reach your full retirement age, you can earn a lot more without having to worry about a penalty. And the benefit penalty is also a lot lower. It is $1 in benefits withheld for every $3. So it's a 33% penalty instead of a 50% penalty. Now let's take a look at that like we did earlier with some numbers. So we've got our friend Mary here, and she's got a $20,000 annual benefit in 2023. She's got earned income from her employer of $40,000 per year. So let's go ahead and apply that earnings test. So we've got $40,000, her earned wages. Your Social Security benefit isn't factored here. Only your earned wages and some of those other income components that we saw earlier. But $40,000 minus that $21,240 exempt amount. And this number increases every year. Mary is $18,760 over that exempt amount. Okay, so that is the amount that is subject to the penalty. So if we look here, $18,760, and it's one for every $2 over, so 50% penalty, ends up being 50% of the amount she was over, which is $9,380. So what does that mean for Mary? Well, Mary is going to have her benefits suspended in the year 2024. Her benefit will be reduced, to $10,220 in the year of 2024. How do we come up with that number? Her original benefit amount was $20,000, but she decided to continue working. The Social Security Administration imposed the penalty with this math we did, and so they deducted or reduced her $20,000 annual benefit by $9,380. So her new benefit is $10,220. All right. Now, there's not a section here, but there's another worth mention. And it gets rather confusing, so I'm going to recommend a video to you guys that we did that got a lot of attention, the one I was referring to earlier. You will actually be entitled to a refund of those penalized dollars, the ones you gave up. So in Mary's instance, she was giving up, $9,380 per year for, say, the next until she turns her full retirement age. So if she started early at 62 and kept working, for 4 years, she's going to pay that penalty. 4 years worth of a $9,380 penalty. Let's call it $40,000. At her full retirement age, the Social Security Administration will run some math, and you can learn more about how that's calculated in the video I'm going to post in the chat. So if you guys look in the chat now, you might want to just kind of copy and paste that URL somewhere. You can always jump over to our YouTube channel and find it. But that is going to be recalculated into her benefit. She'll actually get a higher benefit at the age of 66 to recapture some of, well, not some, but all of the penalty that she had paid in. It's going to be structured over a long time. It's just going to increase her monthly benefits. So it's not like they're just going to send her a check for the $40,000 in penalty she paid. They don't do it that way. What they'll do is they'll increase her monthly benefit using a formula, and she'll get a higher one in perpetuity throughout retirement to recapture those penalties. Okay, so another important factor here is that we have mentioned the exempt amount when filing before your full retirement age. We mentioned what it is in the year you turn your full retirement, but we didn't tell you what happens after you attain your full retirement. What happens then? Well, once you reach your full retirement age, you can actually earn as much as you want without facing a penalty. There is no reduction in your benefit once your birthday is concluded, your full retirement age birthday. That's it. You can earn as much as you want while collecting your benefit with no penalty. And again, that benefit will be factored up. It'll be higher had you paid a penalty in the past. Now, moving on to our next slide here, we're going to get into determining your benefit. And there are really two options available to you. The first is that you can create an account or log in if you have an account at ssa.gov, and you can review your annual statement. And they've revamped that website as of recently. The last few years, maybe 3 or 4 years ago, they revamped it, and they've done an incredible job. So in the past, 5-10 years ago, it was archaic, it was difficult to walk clients through those statements, but it's gotten a lot better. The other one is that you can just use, if you don't want to log in or create an account, you can use an online retirement estimator tool. And if you guys want access to those, let me know in the chat. I have no problem sending that to you. And that just asks you for several pieces of information, and boom, they'll spit out an estimate. The downside is that it's not very accurate. It'll give you a ballpark, but it's not super accurate. So I would always recommend just logging into ssa.gov, creating an account, getting in there and starting to take a look at those projections. And that's typically what we require when we're sitting down with clients anyways. We kind of need to know as retirement income planners, what we're going to receive. Using the retirement estimator tool can be off by $500,000 or more. So it's not super accurate. So always log in if you have the opportunity. Now, here's just a quick look at some of the things you'll get access to on the back end. And I'm going to skip to the next slide because this one's not nearly as important as this one here. It's your earning record. It's really cool. You can get in there and you can see how much Social Security you paid in every year all the way back since you started working. You'll see your earnings tax for Social Security, meaning that that's everything below the ceiling I mentioned earlier. Remember, you only have to pay Social Security tax up to a certain amount of income earned annually. Anything under that, anything over that, you don't pay tax on. But you'll see that here, earnings tax for Social Security. So you'll see your earnings in every one of those years all the way back. And you'll see the Medicare kind of column there too. And on that same screen, you'll also see the amount of tax that you've paid in your Social Security tax. You'll see it for Medicare as well. One thing I would recommend, going back to the last slide, is if you have a way to verify those years of income, I would do it. We've had clients come in and sit down. We've gone through their earned wages and compared them. And in some cases, the Social Security Administration was wrong. And if you can prove, with documentation that you earn more in any of those previous years, they will honor that, provided that you have the documentation. So moving right along to the benefit statement, you're going to see inside that system something that does look better than this, but this will give you a rough idea. Typically, you're going to see 3 ages, estimates for 3 ages. The first you're going to see is age 67, your full retirement age, 66, 67, again, dependent upon the year you were born. It will be in there though. It'll give you your full retirement age and the amount you can expect to receive in a monthly. if you file at that age. You'll see it for the max age of 70. And then lastly, you'll see it for the age of 62, taking it at your earliest. Now, one downside, the only downside, but there is a remedy here, is that it's only going to show you these three. They put a lot of emphasis on those three. However, you don't have to start your benefit at 62, your full retirement age, or 70. You can actually start it at any time. For example, we talked earlier that if you take early at 62, the reduction is 25%. But if you took it like 64, say, or even 65, because a lot of clients will retire at 65. They won't wait, until 67 if they're born after 1960. They won't wait till 67. They don't want to wait another, 2 or 3 years if they don't have to. Really, what the marker that they want to hit is 65 because of Medicare. They want to, they don't want to come out of pocket premiums for medical insurance every month. They want Medicare to cover that. So 65 is a pretty common number when it comes to retirement. And they don't have that illustrated in the back end here. However, there's a tool in there. We help clients with this all the time, where you can plug in the age that you desire to retire at, and it will go ahead and spit out, it'll compute right there live what your benefit will be at that age. In addition to that, your ages are likely to increase. The system's not smart enough to know that. You can go ahead and plug in any hypothetical amount. So if your employer typically gives you a 3% raise every year, we can increase your annual wage by 3%. We can stick it in there at 65. Boom, we'll get a very accurate estimate as to what your benefit will be at the age of 65. And the system's smart enough to factor in COLA. Now, COLA is difficult because it can change, like we saw drastically in the last 2 years, but they have an average in there and it'll just simply apply the average. So we'll get very, very close to what your benefit would be. Now, I would say, again, this is kind of emphasizing on the importance of creating an account and logging in. You want to use that website. You don't want to use the estimator tools, although you can. You want to log in because it is very accurate. Now, another couple considerations for those who may have worked for a government subsidy or agency, or maybe married to somebody who has worked for the government, is that you could be faced with two provisions that are not factored into that estimate. So we've also had to help a lot of clients here as well because their systems aren't sophisticated enough to know, whether or not you are a government employee and how much your pension is going to be. But basically, these two provisions can reduce or even eliminate your Social Security benefit. And they're known as if you work for a government employee. And they're known as the Windfall Elimination Provision, or WEP, and the Government Pension Offset, GPO. And WEP, of course, you'd be weeping if you have a reduction in your benefit that you worked your whole life for. The question is, why do they do it? Well, the Social Security Administration doesn't want you double dipping. In other words, some people, what they would consider doing is working for 10 years to get their 40 credits. That way they're entitled to 100% of their benefit at their full retirement age. And then go off and maybe put in 30 years for CalSTRS or FERS, something like this. A employer where they don't pay Social Security tax. So they call that a non-covered employer. A covered employer, you're paying Social Security tax. Non-covered, you're not paying Social Security tax. So they'll go do 35, 40 years for a non-covered employer. Then they'll get to retirement and they'll take their big fat pension and they'll take their Social Security benefit. So they've got a nice monthly income. And personally, if it's me, I think that that's fair. But the Social Security Administration doesn't like it. They don't like that. They put limitations on it. And what they'll do is they will reduce your Social Security benefit if the amount you're receiving from your pension is what they consider to be too high. We can talk more about that if you guys got questions. We also have calculators in-house where we sit down with clients and help them factor what their benefit will be considering their government position and their pension. We can get estimates from their pension company, and we can do all the factoring there. But the point is that if you work for the government and you're not paying Social Security tax, that you're very likely to come into one of these two provisions. And by the way, for some of you who work for the government, not all of you guys work for an uncovered employer. As a matter of fact, the United States Postal Service, for instance, they're FERS guys. So FERS guys, who used to be SERS guys, FERS guys now do pay Social Security tax, so you'll be entitled to a benefit, your full Social Security benefit, that is. But for those who are on SERS, for instance, who are never paying Social Security tax, they won't see a benefit. Another healthy takeaway from this, though, and why we're on the topic is, so my father actually, he worked for USPS for many, many years. So I, helping him retire, looked into all the pros and cons. And one of the pros was that you can actually collect your benefit while you're still working, as we talked about earlier. And as long as you're not taking your pension, so you haven't retired yet, you can continue receiving that Social Security benefit until you retire. So for him, he's receiving a reduced amount because he's got the work penalty involved, but he's nonetheless receiving a monthly benefit. Now, when he retires, that benefit will go away because the Social Security Administration will catch wind of his pension and they will recalculate, and it just so happens that his pension will be too high. He's collecting too much from the pension, and his Social Security benefit will be eliminated entirely. So he worked during the SERS days, CSRS, the Civil Service Retirement System. And many of you guys had moved over or started on the FERS system, the Federal Employee Retirement System. Now, that's windfall elimination provision. And for spouses with survivor benefits, so if you married a spouse who you are going to inherit pension from that was a government pension, then you're going to have this formula applied to you as well, and your benefit may be reduced, if not eliminated. So if you guys got questions on how that'll look for you, you're more than welcome to reach out to us. Again, I'm going to do kind of a little offer here at the end, and we can set something up to look at your situation. So here's just a quick slide on the things we just talked about, a little more detail. So we know that it affects government employees of state, local, municipality, and federal jobs. Typically, it's like a 2/3 rule. That's kind of the rule of thumb. So if you take your pension and you multiply it by 66%, and then you subtract it from your Social Security benefit, if that number is positive, you're unlikely to receive a benefit. That's just that's a rule of thumb. It's a rough kind of estimate. The statement is reduced. Yes. Okay, we'll move past that slide because I just covered most of that in the previous. Here is, if you want, you can take a screenshot of this. It's just kind of a quick chart where you can start up here on the top left, and it asks you a series of questions, and it will help you decide at a very high level whether or not you're likely to face the windfall elimination provision. So you guys can screenshot that. I'll give you a second to do so. And if you want it, I can send it to you. It's not a problem. As a matter of fact, I can send you guys the slideshow presentation. I'll send it to you all once we conclude. All right, so moving on to our favorite topic, taxation. All right, so do we have to pay tax on our Social Security benefit? And the answer is maybe. First of all, we learned earlier that FICA tax, your Social Security is, the amount you pay in FICA tax is split between Social Security and Medicare. 7.65 total, 6.2 to Social Security, and 1.45 to Medicare. Getting beyond this slide, though, there is a wage cap. I mentioned that earlier. 2022, it looks like this slide wasn't updated, so it's going to be a little higher, but that max earning is about $147,000 per year. So anything over $147,000 is not subject to that 6.2%. But let's get into the reason why you guys came, if you came for taxes, which is it taxable? How do we know? Well, that depends on something called your combined income. And your combined income is made up of a few things. It's your adjusted gross income. And if you want to know your adjusted gross income, grab your last year's tax return, your most recent tax return, and on the first page, look down towards the bottom and just a line in bold that says adjusted gross income. If you don't have a copy of it or aren't savvy enough to find it, call up your CPA or your tax preparer and ask them if they can give it to you. Plus non-taxable interest, you can also find that on your 1040 or ask your CPA, plus half of your Social Security benefit. And that is what's called your combined income, a very important figure. Why? Because if you're married filing joint here on the left side, and your combined income is between $32,000 and $44,000, then up to 50% of your benefits taxable. A lot of people get confused at this part of the seminar or even webinars. We do these in person too, so I say seminars, but the webinars. It doesn't mean that 50% of your benefit will be taken or taxed, as in you have to forfeit it to taxation. It just means that 50% of that benefit will be included or run through the tax calculation. You'll pay some percentage of it. So to give you an example, the average retiree's effective tax rate, the average tax that they pay on the federal side, is about 10 to 15%. So if you've got a benefit, if you earn between 32, your combined income is between 32 and 44,000, and using our example, you have a $20,000 annual benefit, $10,000 will be added to your taxable income. And if we're assuming 10 to 15%, on the low side, about $1,000 of that will be paid in tax. So you end up pocketing $9,000 in this example. And on the high side, $1,500 will be paid in tax. You'll end up with $8,500. $85 plus the other 10. You'll end up with $18,500. In the first example, it's $19,000 total. And in the second example, it's $18,500. So they're not taking 50% of your benefit in tax. They're simply taxing 50% of your benefit. Now, for those who earn $44,000 or more, it's up to 85%. An easier example here is instead of a $20,000 benefit, let's say your benefit's $10,000. Make the math simple for me. So $10,000, you earned, your combined income is more than $44,000 per year. 85% of that, or $8,500, will be subject to tax. If the average is 10% on the low, then $850 will be paid in tax, and the remainder, which is like $7,750 or something like that, $7,750, you will keep. Okay, excuse me, it's $850 less $10,000. So 800 minus 10,000 is 12. $91.50, $9,150. But they're not taking 50% of that 85% of that 10,000. You're not going to pay $8,500 in tax and be left with a $1,500 benefit. So it's a misconception when we get to this point in the presentation that a lot of jaws drop in the audience. Now, for individuals, it's a little different. So on the combined income side, we've got 25 to 34,000. That's obvious because it's an individual and they only have one income stream. That's up to 50%. And if they earn 34,000 or more, it's up to 85%. All right, so that's roughly how your benefit is to be taxed. Let's talk about some strategies that you guys can implement in order to reduce your lifetime tax liability. And I'm going to start with two types of income, one being favorable and the other not so favorable. Let's take a look at those. So we've got type of income here, we've got unfavorable and favorable, and then we've got the associated tax. So this middle column here, this unfavorable, these are the types of incomes you want to avoid. It's likely you won't be able to avoid them, but if you had the choice, or you can, you want to. Earned income, including wages, salaries, and tips. Those are what you guys take from your employer as you're working for them annually, and you are faced with the highest tax rates on those and any of the rest. Social Security, pensions, interest, annuities, ordinary dividends, short-term capital gains, unemployment, rents, royalties, and so forth. Here's another one that people don't think about until they get hit with that big tax bill from Uncle Sam. Your withdrawals from your retirement account, 401k, Simple SEP, IRAs, all of it is taxed at the highest tax rate, the ordinary income tax rate. Just a consideration for you. Now, on the right-hand side, we've got more favorable income streams. So what are those? Capital gains from the sale of an asset, such as a stock, home, business, and qualified dividends. So pretty much what I mean here is if you hold a capital gain that's longer term is what I mean here for which means holding it for more than 12 months. The next is a sale of highly appreciated inheritance for a step up in basis. If you inherit a property, say a home from your parents that they bought for cheap back in the 20s or 30s, say 40s or 50s, whatever, and they bought it for say $50,000, nice big home, and now it's worth $1 million or $500,000, whatever. When they die and you inherit that property, your new cost basis, the amount that you'll have to pay tax on, is brought up to current market value, fair market value. So if the house is now worth $500,000, you won't have to pay a tax on anything over $500,000 if you decide to sell it. If they were to sell it and then pass it to you, that would be a big mistake because they'll have to pay tax on the difference between $500,000 and $50,000, which is a $450,000 capital gain. And now, obviously, there's a little bit more to that story because each spouse is entitled to a $250,000 capital gain exclusion. So in that example, it wouldn't really matter because that $500,000 would cover the $450,000. So if I brought that value of the home up to $1 million, it would be different. They'd have about $500,000 in capital gain tax to pay. That would be terrible. But you, if they passed, would inherit that home and be brought up to that $1 million. You could sell it the next day and not pay a dollar in tax. Now, if you wait a year and the property value goes up, you'll pay tax on the difference. So if over the next year, the property grew in value by 10%, so it's now worth $1.1 million, you will pay tax on the $100,000, less your exclusion, of course. If you lived in the house, you've got the $250,000 exclusion. If you have a spouse, you got a $500,000 exclusion. So that would take care of the $100,000, but just trying to paint the picture for you guys. Now, tax-free investments including municipal bonds, tax-free ETFs, and Series I bonds. Series I bonds, if you guys didn't know, kicked a lot of butt the last couple of years. I think at the highest they were paying about 9.25%. We directed a lot of clients to Series I bonds. We don't get paid to sell them, which is unfortunate. However, it's good for you guys. We are fiduciaries, so we got to kind of put your interest above our own. And there's also limitations on them. There's like a $10,000 limitation on an annual basis. You could, if you still want to invest in them because they're still pretty hot, you could actually kind of force a refund if you don't get a refund on an annual basis and use that refund to buy an additional $5,000 worth of I bonds. Your spouse is also entitled to the same, and your kids as well. So some of the clients, what they'll do is they'll open accounts up in, for the grandkids, for their own kids, and they will buy these Series I bonds for them. That way they can take $10,000 and over, maybe upwards of 50, 60, 70K and so forth. Now, municipal bonds, some of the other tax-free instruments there, we invest in for clients here at the firm, and you've got, like I says, tax-free ETFs. Those two work well together in our portfolios. There's a lot of math that's got to happen there because these tax-free investments will always pay less than the non-tax-free ones. So that's why sitting down with an advisor makes sense, because we can figure out what your tax rate is and then say, okay, is it worth buying the tax-free lower yield of a municipal bond, or should we just go ahead and buy the corporate ones without the tax break? Depends upon what your effective tax rate is, and we can do that math for you guys. Distributions from a Roth IRA or cash value life insurance via loans. So I'm not a huge believer in cash value life insurance. When I was getting started, I was, because all of the big guys push it. They make a ton of money selling that stuff. I'm kind of a buy term, invest the rest, kind of a Dave Ramsey, Susie Orman. I kind of follow that philosophy. But nonetheless, if you do have cash value life insurance policies, that can be used to supplement your retirement income in a tax-free way. So when they told you that, it is true. You can take it out via loans, and there's a way to set it up so that the loan's interest is being paid back to you. And you can just have this kind of rolling loan that you never really have to pay back, that's reduced from your death benefit. And your death benefit is reduced by it. So that works for a lot of people. Roth IRA, if you guys didn't know, is one of the best investment vehicles of all time because although you fund it with post-tax dollars, money you've already paid tax on, it grows tax-free. So all the interest that you will have earned will be tax-free. And we don't know where tax rates will be tomorrow, but we do know that there are two ways to cut the deficit, and that's either you can cut spending or increase taxes. And sadly, the politicians have always voted for the second, increasing taxes. Taxes are going up. And so it's likely that taxes will be higher in the future, so that Roth comes in handy. Now, these again are the more favorable types of income streams that you want to set up for yourself. Let's take a look at what that means. What do I mean by higher tax rates? And so we see here on the left, unfavorable income tax rates. This thing goes all the way up to 37%. Be it you have to be earning $500,000 a year or more. But regardless, 12, 22, 24, a lot of us will fall kind of right in those first 3 or 4. However, on the other end of things, the more favorable income tax rates, for those mentioned on the right side of the previous slide, we see if you can earn up to like $41,675 here and pay 0% tax. 15% on 41 to $460,000. Again, most of us aren't going to be there. Quite a few of us will follow between 40 and 100. And it's only 15% compared to where you'd be on the left side, much higher rate. And then 20% over 459. And we've got a few clients that are there, and they're happy to have a portfolio that's built to generate an income that is tax favored. All right, so here are a couple other strategies. I'm going to continue here because taxes are one of those things, again, I spend a lot of time in, but also it's just the easiest way to kind of reduce your annual liabilities. All right, so income strategies. Follow liquidity priority. So this is a little tricky, but all it means is that when you retire and you start withdrawing money from your retirement savings to supplement your pension and Social Security, you want to start with cash, and then you want to move on to your non-qualified brokerage accounts, so stocks that are invested with after-tax dollars. Then you want to move on to your 401ks. You want to leave the 401ks for just about last. The best for last is Roth. But you don't want to take those 401ks, SEPs, IRAs, Simples, anything that you are going to pay tax on, you want to defer that for as long as you can. The next one is going to be reducing your income to cover just the necessities. Why? Because the more you withdraw from those retirement accounts to supplement your income, the more tax you're going to have to pay. Unfortunately, the majority of retirees have invested their monies in pre-tax vehicles. So they're going to be subject to that ordinary income tax rate, which we learned is the highest tax rate. So keeping your expenses low will help reduce your tax burden over your lifetime. The next is to eliminate debt and to withdraw less from retirement savings. So this one above here was about keeping expenses low. This one here is a way to keep expenses low, and that is by paying debt off. It's funny because one of the questions I'd get most often when I was doing tax work was, should we pay the home off? We've got $100,000 left in the home, $150,000, we've got cash, we could pay it off. A lot of tax guys would tell their clients, no, you want to keep the home, keep paying on the home because you're getting this write-off. But the standard deduction nowadays is doubled. It's like almost $13,000 for individuals. It's going on $25,000 for married couples. And what does that mean? It just means that interest you pay on your home is not likely helping you on your taxes. So it's not really worth the tax break to keep the home. In other words, you should pay it off. Because if you pay it off and you're retired, you're not going to have to use your retirement. You're not going to have to pull as much out of those retirement accounts in order to cover those expenses. So that's eliminating debt to withdraw less from those retirement accounts. The last one is going to be keep 3 buckets always if you can. You can do a Roth IRA to get more money out of the 401ks, a Roth conversion, and into a tax growth tax-free growth environment. But you want to have three. You want to have a bucket that's taxed on an annual basis called a brokerage account. You want to have one where it's totally tax-free, which is like a Roth IRA, that cash value life stuff. And then lastly, you want to have deferred tax, which most of you will. That's the 401k, SEP, Simples, IRAs, 457 plans, anything that is deferred tax. Now, we've got a couple other strategies on the portfolio side of things. So again, as mentioned earlier, we do help clients create and manage their retirement investments. One of the strategies we use, and you can too, is asset location. It's very important. You want to keep your equities in your brokerage account. Your stocks you want to purchase within your brokerage account. You don't want to buy anything within your brokerage account that's going to spin off a yield or income, such as bonds, for instance. They're going to produce an annual income. Now, that income is going to be subject to tax in the year that you earned it. And if it's in a brokerage account, if it's earned in that year, it is taxed as short-term capital gains, the highest tax rate, the ordinary income tax rate. So instead, what your advisor or you or hiring us would do is we would make sure that your brokerage account has long-term investments only that aren't producing an income. And in the 401ks or the deferred tax investment vehicles, we would make sure that you're investing in those positions there. So the bonds we will have in the 401k, for instance. Now, next, purchase and hold dividend producing stocks for qualified dividends. Qualified dividends. We have some of the companies nowadays, big blue chip companies, Verizon, AT&T, paying 5 and upwards of 8% annual dividend. We've got a portfolio for clients, a dividend portfolio for clients, again, producing between 5 and 8%, well diversified across over 100 companies. It is a great way for you guys to reduce your tax burden coming off of the income that your portfolio is producing. If you hold those positions for more than a year, those dividends you're receiving are now qualified and subject to a much lower tax rate, the one we saw on the right earlier. You want to also hold assets for more than a year. I just mentioned that in the brokerage account. In doing so, you'll be facing long-term capital gains, not short-term capital gains. So again, long-term capital gains, we saw the two unfavorable and favorable. That belongs to the right. On the next slide, we saw the two tax tables. It's the one on the right is qualified dividends. Purchase municipal bonds, I-bonds, and tax-efficient ETFs. I just mentioned that a little while ago. And then IRA to Roth conversion. So again, going back to that bucket, setting up those three, if you're highly concentrated in your deferred tax bucket, we can run a comparison for you or a calculation for you to see if converting some of your IRA money over to a Roth via a Roth conversion would make sense. So you can kind of, if this bucket's filled and this bucket's low, you can kind of pay the tax on this bucket today to fill the bucket up on the right. Now, again, that doesn't work for everybody. It's probably like a 50-50 split. But we can find out by running it through a series of calculations if that's going to work for you or not. And the idea there is that if tax rates are higher in the future, now you're able to take from this bucket where you don't pay tax. And then in lower tax years, you would take from the buckets that you do pay tax, and so on and so forth. So let's get to our next slide here. We've got credit strategies. I'm going to kind of run through these here. You've got family independent, elderly, disabled, child tax, and EIC credits. And I would just talk to your CPA about what those mean. Again, a screenshot would do well for you. Just says, hey, look, I attended a webinar and these are some of the things I want to make sure I'm taking advantage of these on an annual basis. We've got income and savings. So there's savings and foreign tax and excess Social Security tax credits. Homeowners, so energy efficient electric vehicle, solar, you've probably heard of them. Again, these are things that you should reach out to your tax preparer or CPA for. Hey, Tom, I was thinking about putting solar on. How is that going? Is that going to impact me? Be mindful that a lot of those who are pushing these tax incentives might not know your unique tax situation. To give you an example, I had a client who came to me who one of the solar reps was pushing a $10,000 credit. However, it turns out that it wouldn't work for her because it's a non-refundable credit. And a non-refundable credit means that it will only help reduce your tax up to the amount that you owe. So if you've got a $10,000 tax bill come January, then fine. The solar will have panned out. You'll recapture that $10,000 and have a zero tax liability walking out the door. However, if you're entitled to a refund, say of even $1, you will not see a penny of that $10,000 non-refundable credit. And so you need to find out when working with your CPA or even us if the credits you're looking at are refundable or non-refundable and whether or not they will work for you. Healthcare premiums and health coverage, and then we move on to capital gain strategies, sell highly appreciated inheritance at step-up in basis. I mentioned that earlier. Make sure you never, ever, ever sell or request or require or allow your parents to sell a property that you are to inherit. You wait until they pass and then you inherit and sell if that is ultimately your decision. Tax harvest to offset gains. In years where the markets are down, one strategy we use for clients is to sell. And then typically we'll rebuy. There's some limitations there. You can't buy the same stock within X amount of months. However, you can take a loss. You can sell and you can rebuy a very similar asset class. And you can now take that loss for the year. When the market comes back, you'll be right where you were, back to where you were, but you can take this big loss on your tax return. So you can realize that. Maximize rental write-offs to reduce capital gains and income. So obviously you guys have heard of the Schedule E if you are property owners. And in the Schedule E, there is a whole list of things that you can take advantage of in terms of reducing or even creating a loss to reduce your taxable income. And I'm kind of listing a few there: amortization, repairs, maintenance, and so forth. Now, I'm going to go ahead and we're kind of wrapping it up at this point. I'm going to throw an offer at you guys for attending, those who attended today. It's a complimentary retirement analysis where we will review for you all of the things that we discussed today. We'll have an income analysis in there. We'll talk pensions and Social Security, benefit estimates, taxation. We'll give you a full-on report as to what you can do with recommendations to reduce your annual tax liability. And so it's a pretty comprehensive approach to retirement planning, but one well worth it. What's in it for us? Because it's $2,500 value. So what is in it for us? Well, typically the recommendations that we make to you guys will fall in line with one of our products or services. And so if that is the case, we will disclose to you what we earn by providing that service or profit or product. But that's the reason why we do offer the value. Here are some of the things you can expect or anticipate coming out of that consultation. And so you'll have a retirement income forecast. So you're going to see your pensions and your Social Security. You're going to see your retirement shortfall, your retirement income shortfall projection. So, you take your Social Security and pension less your monthlies. So we'll help you with an expense sheet you'll fill out so we know what your expenses are in retirement. And if there's a negative there, it's going to show how much that is, because we need to know what we are going to be withdrawing from your retirement savings on an annual basis, and if we can keep up with that in the markets. And we'll have a detailed investment analysis. So we'll take a look at how you're investing currently and help you decide if that's the right place for you. To give you an example, I've got clients who came to us over the last couple of years who only need to generate about 4.5% to 5% to cover their shortfall. And here their advisor has them in like a highly aggressive portfolio, and they're sitting at home biting their nails and keeping themselves up at night worrying over the markets when they could simply buy treasuries. T-bills right now are paying 5.5%, 5.4 as of this morning on the 3, 6, 9, and 12 month. And so they could definitely sleep better at night while having capital preservation by simply investing in T-bills. So there is a myriad of reasons why you should have somebody look over your investment accounts. Doing it yourself, maybe, I would caution you. Most of the people who tell us they do it themselves open up their portfolio and they might have like 3 or 4 funds in the portfolio or positions. And I think, look, guys, you got to seek some professional help. Impact of premature death. if your spouse dies, we learned earlier that you're only going to receive the highest of the 2 Social Security benefits. That could be a dire situation for a household, just you on your own. And there may be pensions there. There may be other income that is dependent upon their survivor. But in their absence, you are now bringing that household income way down. As a matter of fact, to give you an example, at the passing of a spouse, on average, 50% of the household income is lost, but 85% of the household expenses remain. Only 15% of your monthly expenses are lost at their death. And so you lost half your income, but you've still got almost all of those expenses. Investment lost to stock market. So we'll just kind of give you an idea of what it looks like if you were to take big losses in your portfolio over the coming years, and if you can withstand that. We do something called a Monte Carlo simulation. We run it 1,000 times. It's the software that does it, not us. But it will help us decide if all of the components in your plan make sense 1,000 different times, 1,000 different ways, I should say. And it just makes a bunch of different tweaks in there. So it increases taxes, reduces taxes, increases, your annual returns from your investment portfolio, exaggerates your losses. Rapid inflation, double taxation. These are things you want to look at. If inflation continues to spike, how is that going to look for you in the future? Are you going to be able to keep up with it? Social Security and your pension may offer you increases on an annual basis via COLA, but your retirement accounts will not. They're going to have to keep up with within the markets. Can your portfolio, can your retirement plan handle that? And then double taxation. We're in the lowest tax rate environment since 1930 to 1980. There was a 50-year span where tax rates at the time were as low as they are today, but we are technically in the lowest historical tax rate environment. And seeing as that we have spent trillions of dollars worth of stimulus monies back in COVID 2020, the feds are likely to begin increasing your taxes. They have nowhere else to go. Can your plan handle that? And we will find out by putting together this plan. So if you guys are interested, I'm going to go ahead and post a link now in the bottom right over there in the chat box. So let me go ahead and get that for you guys. It says 20-minute consultation, but don't worry about it. We're going to spend that first, it's usually 3 meetings. The first meeting is collecting income, expenses, assets, and liabilities. Then we'll have a second meeting where we follow up, and that's where we kind of lay it all on you. Hey, here's what you're doing right, and here's what you're doing wrong. These are the things to look out for. And these are how you can solve those problems, these recommendations. Again, we'll talk life insurance, long-term care, investments, taxes, income, pension, Social Security, the whole bit. And you can click on that link in the chat, and that will take you off to a little app called Calendly. It's a calendar, and you can choose a date and a time, and one of our fiduciaries will call you. You'll even hear from me oftentimes. And so I'm still very much involved with the clients, and especially with new clients. We've got a team of 6 here. And so I'm kind of leading new client acquisition with a few others. So you guys are more than welcome to click on that and schedule a time and a date. If you have any questions, if you guys are in the room and you've got any questions, I'm happy to answer them at this time. So just plug them in that little chat box and I will get to them. We have someone that says my guess was going to be 200K from Mr. Bob Ackerman. You were pretty close. Yeah, it's about, like I said, 135. I think that projection changes year to year. But it's not nearly as high as that 10 years at $2,000 a month. Again, that's about $250,000 with COLA adjustments over a 10-year span. And so that ends up being a lot more than what the majority have been able to save over 40 years. So if anybody has any questions at all, now's the time. Otherwise, I will wrap it up. And I can send you guys, if you want, I'll just send it anyways. I'll send you guys the slideshow presentation. That way, again, you can kind of go back and look over the things that we discussed today, and you won't necessarily need the screenshots we talked about earlier. You can just take what you need from the slides. And again, like I think some of the more important ones were those tax slides where you can go and ask your CPA, hey, are there, because you got to remember when you guys go in at tax season, I did taxes for 10 years. And so it's cyclical. We've got 3 months to see thousands of clients. And so you're very busy, and it's difficult to spend the time making recommendations to a client when you've got somebody in the lobby waiting for you to do their taxes. And so by calling your CPA off season, that's normally always recommended. Don't ever call them January through April. Call them off season, and call them May through December, and just ask, hey, look, I saw this presentation, and I want to make sure that I'm taking advantage of all the credits and any way else any other way to reduce my annual tax liability. I've been doing taxes, like I said, for a very long time, so you're more than welcome to ask me. You want to do that by scheduling on the calendar via that link down there. So since I don't see any other questions coming in, I'm going to go ahead and log off. I thank you guys all for your time today and joining this event. I hope that you were able to take away some value and get an education on the topic of Social Security. It's a rather big topic. It has been many years that I started learning, and it seems as though I continue to learn about it. And then you've got retirement as a whole, which includes many components. So there's a lot to it. Sounds easy here in the presentation, but that's years and years of it. So again, if you guys need any help, let us know. But more importantly, hopefully you did take something away from today's presentation. We'll be hosting another event here, likely on Medicare in the very near future over the next couple of weeks. And that's another, I'd say, pretty challenging topic as well, because there's a lot to it. But getting an education on some of these pieces is going to be one of the best decisions you'll ever make. I've seen so many retirees make mistakes when it comes to managing their retirement plan, just going out and requesting their pension paperwork or Social Security application and doing it themselves. Pension, I can't tell you how many times I've seen issues there. I've even seen people making mistakes. Probably one of the worst mistakes I ever saw was a client about $1 million in their 401k and unknowingly completed the application, but checked the wrong checkbox and took a full distribution, a full withdrawal of the $1 million, and ended up paying 40 some odd percent in taxes, not knowing that they needed to take it as a direct rollover into an IRA. And so that was a very costly mistake. I remember sitting down at dinner with her, and I was almost, I didn't even know how to broach the topic. I says, hey, look, I'm noticing something here. I'm not sure if it's hit you yet, but the way you took the withdrawal was purely as a withdrawal, and you will have to face a tax consequence here at the beginning of the year. And she asked, well, how much? And when I told her, I thought she was going to faint. And it wasn't the first time that happened either. Pensions, people make mistakes there all the time too. They meant to take a spousal option. They end up taking single life. They should have taken maybe a lump sum option. Because when it comes to pensions, you have to be wise. The amount that pension company is going to provide you, there's actually a little trick here you can do. Take the pension amount, any of those, joint life, single life, take that amount and divide into it the monthly benefit there, take your lump sum option and divide into it the monthly benefit, whether that's single life, joint life. Multiply that by 12, that monthly benefit, and then divide it into that lump sum. And if that rate is anything 5%, or if it's less than, say, probably 5 to 6%, if it's 5 or 6%, it's starting to get questionable. But if it's less than that, there are other companies as big as the pension company that's currently holding your investment dollars who will offer you more. And there's really no difference between the two other than those are the ones that have been holding your money for so long. So yeah, mistakes that people make, it's very common. So anyways, I hope you guys have a wonderful day. Thanks again for joining. Mr. Ackerman, thank you for attending today's event, and look forward to seeing you guys in the next one. Have a wonderful day.